From the floor of the CME Group, this is Danny Riley on this Wednesday, February 3rd. I got that a little mixed up. But anyways, you know what, there's a lot to talk about here today. The S&P is kind of weak because the S&P is talking about a downgrade of Spain. That's the country's credit worthiness. Back in January of 2009, the S&P downgraded Spain from AAA rating to a AA plus rating. And this morning, what we're hearing is that there may be another downgrade coming, and what people are doing is they're selling Spain and buying Italy. Well, the effect of that has been on the S&P has been kind of a negative effect as we're down a little bit here. We sold off from 1099.5 down to 90.5, and we're right around the 93 even level. And I think a lot of this is due to the kind of dark cloud over the S&P and over the Spain story. It's also, Jason pointed out, you can look this up in Zero Hedge. Also, Jason mentioned that Portugal is kind of in the same situation, also looking at maybe another downgrade from the S&P. Over in the 10-year note options, volumes are very, very light. They've got about 15,000. Over in the Eurodollars, they've got very, very light volume over there. They've only got 33,000. You know what? People are a little confused. They're looking at the stock markets. They're seeing interest rates. Everything's tend to be exactly the way it was last year as we went into the end of the year. But we've had this big decline. Now the markets move back up a little bit. What we did earlier in the week from the equity report that the desk write on Monday in the equity report, when the S&P was trading 1077 to 1081, the equity report said that we thought that the market was back and filling again. And for us, that means that the market was setting up to move higher. And yesterday it did. It was up 15 handles. You know, for the rest of the day, we think that things are going to remain a little bit weak. But you know what? There's not a lot of trade here. Right now, we've got 8,000 big S&Ps and about 900,000 minis traded. This is a far cry from what we were seeing about a week and a half ago when the mini was doing over 3 million a day and the S&P was doing 30,000 a day. These guys in here are hungry. They need movement. They need the S&P to crack down hard. This is where these guys make their money. And the real problem here over the last couple of weeks is these guys in the pit are gun shy. Over the last year or so, after the market made its low, this back and fill pattern that's helped the market move up higher throughout this period has been a predominant piece of the way the market's acted. Now, when the market started selling off, these guys were a little gun shy. The market would come, the S&P would sell off 3 or 4 handles from a high. They'd sell it. It would come down 2 or 3 handles. They'd get a little nervous. They cover their shorts, and then down it goes another 10 or 15. So nobody's really getting paid big here right now. As we go into the later parts of the day, you know what? There's some sell stops under the 1090 level and again under the 1085 or 84 level. We don't think they're getting down there, but we do think they could get those 1090 sell stops. Listen, I'm going to step down. We want to have Tim come back and explain kind of where things are from those Dubai lows, and he was talking also about what Jason Carter was talking about.
And this is Tim Hefke from Top Notch Trading. We're on the floor of the CME Group. There was a very interesting question asked to me last week, and it was actually from a member of this group. And it was Brian Shepard who came up with a very key question, and it happened to do with the end of the month's low from last week, which was 1066.70. All along, I said sooner or later we needed to see that little blip that happened over Thanksgiving with the Dubai obstacle that happened. Anyway, Top Notch was looking for that low of 1066.90, and with the low of Friday of 1066.70, Top Notch says that is a good low right now. We're expecting a nice bounce. The high of that week in the S&P at that time was 1111.40. So now our next opportunity to see a move higher will be that 1111.40 level. I expect that to be seen before new lows are made. At this moment, today is just a chicken scratch day. They don't know if they are coming or going. The bonds don't know. They're in a range. We're very tightly packed. The biggest key crucial part of this week comes on Friday. It's the first unemployment data of the year. Actually, it's the first unemployment of the new decade, 2010. This is going to set the way the SPOO is going to head. And if we can get up to 1111.40 and start a further rally, the breakout to those year lows at the end of January was 1127.5 to 1129. That's my top side objective until we see new lows. If we can get up there, we can sustain a further rally. I just don't want to see the 1082 level go anymore. And as we speak, yesterday's low was 84.30. If they maintain a move above there, we should see that 11.1140 before Friday. Thank you.